Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 5. And Chapter 5 is all about financial analysis. Now, in this lesson, there are 8 key areas that we're going to be highlighting today. First, we have the introduction. Second, we will also be discussing the objectives of financial statements. Third, we will be focusing on the limitations of financial statements. Fourth, we have the comparative income statement. Fifth, we will also be discussing the vertical and horizontal analysis of income statement. Sixth, vertical and horizontal analysis of balance sheets. Seventh, we have ratios analysis. And finally, we have business evaluation. Now, financial statements are hot items for all businessmen, right? These statements are great motivators for businessmen to move further as it gives them the measurement or business performance, or what we call feedback value. And they can also be used to predict the future, or what we call as predictive value, using financial analysis. So what is meant by financial statements then? Now, if we say financial statements, these are formal written records of the firm's financial activities and financial performance. This is also known as financial records, and these records are often audited by the government agencies, for example, the Bureau of Internal Revenue, or the BIR, also with the accountants, firms, etc., to ensure accuracy and for tax financing and investing purposes. This is according to Investopedia. Now, there are 6 basic types of financial statements. The first one is we have income statement. Second is statement of comprehensive income. Third, we have statement of changes in owner's equity. Fourth, we have statement of financial condition, or also known as the balance sheet. Fifth, we have statement of cash flows. And finally, we have notes to financial statements. Now, in order for us to better understand each of these basic types of financial statements, we will discuss them one by one, starting with the income statement. Now, if we say income statement, it is a report on a firm's income, expenses, and profits over a stated period. It is also called as profit or loss reports, statement of comprehensive income, or statement of revenue and expense. Now, this is the statement that shows the results of the business operations. The result might be profit if the revenues exceed the expenses, or loss if the expenses exceed revenue. And always remember that if we talk about income statement, the 2 important keywords that we should always remember are revenues and expenses. Now, this is an example of an income statement. Now, as you can see, in generating an income statement, the first thing that we need to do is to write the name of the company. Now, in this case, the name of the company is Company XYZ. And after writing down the name of the company, the next thing that we need to do is to write the name of the statement. And in this case, the name of our statement is basically income statement. And finally, the last thing we need to do in generating an income statement is to indicate the period. Now, in this case, we have for the period December 31st, 2019. Now, the word for the period means that the statement contains figures that transpired only during the period of the statement date. And again, as mentioned earlier, if we talk about income statement, there are two important keywords that we should always remember. First, we have revenues, and next we have expenses. And again, revenues should be deducted by your expenses, and the result that would be your net income. Okay, so this is all about income statement. Now, the next type of statement that we have is the statement of comprehensive income. If we say statement of comprehensive income, this is the statement that shows the earnings which are not yet realized during the reporting period. And this is also an example of a statement of comprehensive income. Again, in generating a statement of comprehensive income, the first thing that we need to do is to write down the name of the company. So as you can see, the one that appears first is the name of the company. And in this case, ABC Corporation is the name of our company. And secondly, we should write down the name of the statement. And in this case, the name of our statement is Statement of the Comprehensive Income. And finally, that would be the period. So in this case, we have for the period or for the year ended December 31st, 2019. Now, what's the difference between an income statement and a statement of comprehensive income? It is called comprehensive income because you are actually adding important information. Okay, so in this case, we are seeing here information in regards to foreign currency, translates adjustment. We also have pension and post-retirement liability adjustments, and information like these are also included in the statement of comprehensive income, and that is why it is called Statement of Comprehensive Income. And next, we have Statement of Changes in Owner's Equity. If we say Statement of Changes in Owner's Equity, this is the statement that shows the changes in equity arising from additional investment and or from the operations representing the income or loss generated during the accounting period. Now, this is an example of a statement of changes in owner's equity. So we have our business name, we have M. Santos. So M. Santos is the owner of the company. And followed by the name of the statement, we have statement of changes in owner's equity, and then followed by the duration or period. So in this case, we have for the year ended December 31st, 2011. Now, based on our definition, statement of changes in owner's equity shows the changes in equity arising from additional investment. Now, as you can see, we actually have an additional investment during the year. So you have there investments during the year amounting to 300,000 pesos, okay? So in this case, you have there the first thing that appears on your statement of changes in owner's equity, you have your M. Santos capital beginning. So if you started January 1st, then you need to indicate your additional investments if there are any, plus the net income, which was the result from your income statement, and you need to get the total. So if there are withdrawals from the company's owner, so you need to include that one as well, okay? And the last thing that you will be seeing in the statement of changes in owner's equity, that would be M. Santos capital December 31st, meaning the capital of the owner ending, okay? So this is the ending equity of the company. And next we have statement of financial condition, which is also known as the balance sheet. This is the statement that shows the financial health status of the business. Now, this is the statement of financial condition or financial position that gives the user information about the condition of the business enterprise as of the given period. And if in income statement, there are two keywords to remember. However, on the other hand, rather, in balance sheet, there are three keywords that we should always remember. First, we have assets. Second, we have liabilities. And third, we have owner's equity, okay? And we will be following the accounting equation. And our accounting equation, that would be your assets equals the sum of your liabilities and owner's equity. So this is an example of a balance sheet. So same with the previous statements, in generating a balance sheet, we should write down the name of the company first. So in this case, our company's name is Teddy Fab Incorporated, followed by the name of the statement. So in this case, we have balance sheet. And finally, we have the period or duration, December 31st, 2100. By the way, some companies put as of December 31st, 2020, or as of December 31st, 2021. Now remember, the word as of means that the statement contains cumulative figures from the start of the business commercial operation up to the present statement date, okay? And as you can notice in our example, the assets are located in the left side and your liabilities and shareholders' equity or owner's equity are located in the right side. And remember that we are using the accounting equation. So the result of your total assets should be equal to the totals of your liabilities and owner's equity. Okay, so the next statement that we have, that would be statement of cash flows. So this is the statement that shows the sources of the firm's cash and how these cash are being spent. In other words, this is the statement that gives information to the users about the cash sources and the cash uses of the business enterprise during a given period of time. Now, this is an example of statement of cash flows. And again, I would like to reiterate, in generating statement of cash flows, same with the other statements, the first thing that we need to do is to write down the name of the company. So in this case, our company's name is Good Deal Corporation, followed by the name of the statement. So in this case, we have statement of cash flows and followed by the duration or period. So in this case, we have for the 3 months ended March 31st, 2019. Now, as you can notice, there are three types of activities under statement of cash flows. First, we have the operating activities. These refer to activities which have association to the operation, okay, in operating the business. Next, we have investing activities. And next, we have financing activities, okay? So these are the three activities that should be appearing in our statement of cash flows. And finally, we have notes to financial statements, and it shows the explanation and details of the various line items in other statements. Okay, now, in order for us to better understand each of these type of financial statement, let us go first with income statement. Again, like I said earlier, there are two keywords that we need to remember if we talk about income statement. First, we have revenues, and next we have expenses. And again, your revenues should be deducted by your expenses, and the result should be your net income. Now, since we are talking about the two keywords, revenues and expenses, let us break it down one by one. So let's break down what are the account names or account titles that are under revenue accounts and the names, the account titles and account names that are under expense account. Now, let us move first to revenues accounts. Now, under revenue accounts, we have a lot. So examples of account titles or names, under revenue accounts, we have service income, we have interest income, we have sales discount, we have sales returns, and sales allowances as well. Now, if we say service income, it can be used for companies which render services in order to earn an income, like the services rendered by beauty salon, barber shop, and repair shop. Now, in order for us to better understand service income, let us have a specific example. Now, this is an example of an income statement. As you can see, this income statement, or the name of our company rather, is Welch and Graham, attorneys at law. So basically, this is a law firm. And remember, law firms provide services. So that being the case, this is a service type of industry. And since it is a service type of industry, the first account name or account title that should be appearing on your statement is service revenue, or you can also have service income, okay? There should be a word service because this is a service type of industry. Next, we have interest income. Now, what do we mean by interest income? When we say interest income, it is a company income earned out of lending its money or depositing money with a banking institution. If we say banking institutions, it can either be banks, cooperatives, and other financial institutions, okay? So these are the institutions that earn interest. Now, in order for us to better understand this, let me show you an example of an income statement. So this is an example of an income statement, and under your revenue, the first account name or title that appears on your income statement is interest income, because like I said earlier, this is an example of companies that earn interest. Again, these are companies that earn interest. Any banking institutions like banks, cooperatives, and any other financial institutions. Okay, next we have sales. So when can we use sales in our income statement? But before that, let us define sales first. If we say sales, it is a revenue account for merchandising type of business organization that is used in selling merchandise. For example, we have wholesalers and retailers. So if you are into wholesaling and retailing business, then this is the account title or account name that we should be using in our income statement. So in order for us to better understand this, let me show you an example of an income statement. Now, as you can see on our sample income statement, the name of our company is Kingram Pencil Pushers Incorporated. And technically speaking, this is a merchandising type of business. This is about wholesaling and retailing. Now, as for that matter, since this is a merchandising type of business, then the first account name or title that should be appearing on your income statement, that should be sales revenue or simply sales, okay? Next, we have sales discount. If we say sales discount, it represents cash discount given to customers for settling their accounts on time. So technically speaking, if you are a customer and you owe something to a certain company and you settle your account on time, then you will be granted sales discount. Example for this here. So in this case, this is an example of an income statement, and the name of the company is Dan Dane's Company. So as you can see, under revenues, you have sales, because we are assuming that this is a merchandising type of business, and it is deducted by sales discount, okay? So that's an example of sales discount because that's a grant coming from the company. Next, we have sales returns. If we say sales returns, it represents actual returns made by the customers due to wrong delivery, wrong shipment, or defective merchandise. Again, we cannot deny the fact that this is very evident nowadays. Companies are not perfect. They are able to send their customers at times wrong shipment, wrong product, or may it be defective merchandise. So if this happens, how can we put sales returns? How will it appear in our income statement? Now, this is an example of an income statement. And again, same company, we have Dundane's company. Now, if you have sales returns, so this will be deducted from your sales, okay? Because this is technically speaking a loss of sales from the company because a certain customer returns their orders due to wrong shipment, wrong delivery, or defective product. So that is why it should be deducted from your sales. Next, we have sales allowances. If we say sales allowances, it represents no actual returns, but an allowance given instead for the defective merchandise delivered. So assuming that I am a customer and I shopped at Lazada or Shopee, and when I received my order, let's just say I ordered a pair of shoes, okay? And when I received my shoes, there is a defect on it. So instead of returning it to Lazada or Shopee, I actually phoned the company or the seller, and instead of paying, let's say, 1,000 for my product or defective product, we had an agreement by the seller to pay it less, okay? So instead of paying 1,000, I only paid 500, okay? So that was an agreement between me as a customer and Lazada or Shopee. So how will it appear on our income statement? So this is an example of our income statement. Same income statement. The name of the company is Dundane's company. So your sales allowances, same with sales discounts and sales returns, it should be deducted from your sales, okay? So that is how it appears in your income statement. And those are our revenue accounts, okay? Next, we have expense accounts. What are the account names or titles under expense accounts? So under expense accounts, we have purchases, we have purchase discounts, we have purchase returns, purchase allowances, salaries and wages, employee benefits, office supplies expense, utilities expense, rent expense, advertising expense, and insurance expense. Now, in order for us to better understand each of these expense accounts, let us discuss them one by one, starting with purchases. So if we say purchases, these are merchandise purchases which are intended for sale. Now, how will it appear in our income statement? So this is an example of our income statement. So you have there sale less your sales returns and allowances and sales discounts as well. So sales less these would be your net sales. So net sales followed by cost of goods sold, inventory beginning. So in your inventory beginning, since you purchase additional merchandise, so this will be added from your inventory beginning, okay? So this is how it appears in your income statement. Your purchases should be added from your beginning inventory. Next, we have purchase discount. If we say purchase discount, it is a discount given by merchandisers when you pay your liabilities on time. Okay, so you are granted discount by the merchandisers since you settled your maturing debt obligation on time. So how will this appear in your income statement? So this is an example of an income statement, and your purchase discount should be appearing right after purchases. Okay, since you added purchases in your inventory beginning, so the result of that will be deducted by your purchase discount. Okay, so next we have purchase returns. If we say purchase returns, this is the actual return of merchandise you return to your supplier due to wrong delivery, wrong shipment, or defective merchandise. Now, earlier we discussed about sales returns. Again, we discussed sales return under revenue account. And sales return is from the perspective of the customer. On the other hand, if we see purchase returns, it is on the perspective of the company. Again, we cannot deny the fact that a certain company has different suppliers, and if they receive orders from their suppliers which are considered to be orders coming from wrong delivery, wrong shipment, or defective items, then of course you need to return these merchandises or items to your suppliers. So how will this appear on your income statement? So here in this case, this is how it appears in your income statement. It will be deducted from your purchases and beginning inventory. Okay, next we have purchase allowances. These are allowances given by suppliers representing reduction of price for purchased merchandise due to defects. Now, earlier we discussed about sales allowances. So the example given was me being a customer ordered a pair of shoes from Lazada or Shopee, and it was defective. So that was in the perspective of the customer. So if we say purchase allowances, this is on the perspective of the company. So they received a defective merchandise. Okay, so instead of returning it to the supplier, they instead agreed with the suppliers to pay lesser amount. So how will this appear on your income statement then? There is a reduction of price for purchased merchandise due to defects. This is how it looks like. Okay, so from your beginning inventory and purchases, this will be deducted from your beginning inventory and purchases. So far we have purchase returns and allowances and purchase discounts being deducted from your cost of goods sold or inventory beginning plus purchases. Next, we have salaries and wages. If we say salaries and wages, it represents the labor payments to employees of the company. So this is what the company should be paying to their working employees. So how will this appear in your income statement? Of course, this will appear under expenses, okay? So encircled with red, that would be your salaries and wages, and it appeared under expenses because this is an expense from the perspective of the customer, because they shell out money. There is what we call a cash outflow from the business. Okay, next we have employee benefits. If we say employee benefits, it represents the labor payments to employees other than the basic payment that are highly discretionary on the part of the employer. So what are the examples of employee benefits then? So some of the many examples of employee benefits, we have bonuses, we have uniforms, we have meal allowances, we have 13th month pay, we have vacation and sick leave benefits as well. Again, these are just some of the many examples under employee benefits. And how will this appear in your income statement? So technically speaking, this will appear as well under expenses because this is an expense to the part of the company. Next, we have office supplies expense. If we say office supplies expense, it represents various office supplies used by the office. So examples of office supplies that we are normally using in the offices, that would be coupon bonds. We have pencils, we have ballpoint pens, papers, paper clips, folders, and so on. Okay, these are some of the many examples under office supplies expense. And in your income statement, it will still be appearing under expenses because this is an expense to the part of the company. Next, we have utilities expense. If this is a utilities expense, these are expenses arising from lights, okay? So you have water bill, telephone bill, etc. Okay, so these are examples of utilities expense. And in your income statement, this will also be appearing under expense because this is considered as an expense to the part of the company because there is an outflow of money. Next, we have rent expense, and rent expense is the rental expense of the business. Supposing the business doesn't have its own land, okay, they are just renting a space. So of course, you need to pay rentals every month. So in your income statement, this will appear under expenses rather, because this is considered as an expense to the part of the company. And next we have advertising expense. If we say advertising expense, this is the cost of promotion and advertising the products of the business for the purpose of improving its sales performance. We advertise our, normally we advertise our products, and so in that way, we will be able to get customers in from our business. Okay, so to make them aware that our business exists. Next, in your income statement, this will still be appearing under expense side because this is an expense to the part of the company. And next, we have insurance expense. If we say insurance expense, it represents fire and burglary insurance of the various assets of the business. Normally, for fire insurance, what is normally insured is the building, okay? And most of the time, the equipment as well. For burglary insurance, of course, these are your big machineries and equipment if there are cases of theft in your company or burglary. Okay, in your income statement, this will still be under expenses side because this is an expense to the part of the company. All right, so those are all the expense accounts under income statement. Again, just a brief recap. If we talk about income statement, there are two keywords that we should always remember. We have revenues and expenses. Okay, moving on to balance sheet. Now, if in income statement, there are two keywords to remember, in balance sheet, there are three keywords that we should always bear in our minds. First, we have assets. Second, we have liabilities. And third, we have capital or owner's equity. Now, in this case, we will be using the accounting equation. And our accounting equation, that would be assets equals your liabilities plus capital. Now, in this case, in order for us to better understand how to generate a balance sheet, let us discuss each of these keywords one by one. So we need to discuss the different types of assets and the different types of liabilities as well, and the inclusions under capital. Now, let us have assets first. Now, under assets, there are a lot of account names or account titles. So under assets, we have cash. And under cash, we have cash on hand, cash in bank, cash in fund, and cash equivalent as well. And also, aside from cash, we also have accounts receivable. Aside from accounts receivable, we have notes receivable, we have merchandise inventory, we have prepayments as well. And under prepayments, we have prepaid rent, prepaid advertising, prepaid insurance, and unused office supplies. And also we have land, building, furniture and fixtures. And under furniture and fixtures, we have chairs and tables, air conditioners, cabinet, electric fans, etc. We also have office equipment account name. And under office equipment, examples are computer, calculator, typewriter, fax machine, photocopier, telephone units, store equipment, etc. Okay, if we say cash, this is actually a generic account. If we say generic account, some companies that engage in simple transactions usually use this account, which could either be on hand or in bank. However, for a company to be more effective in directing its business, cash can be made more specific. Now, the following are the specific names of cash used in academic field as well as in industry. So we have first cash on hand. What do we mean by this? If we say cash on hand, it denotes to money or cash substitutes representing the collection of the company awaiting deposit to the company's depository bank the following banking day, or if the company has collection on non-banking day, it has no choice but to wait for the next banking day. Next, we have cash in bank. If we say cash in bank, it denotes to the money of the company that is in the bank awaiting payments. Now, if some companies maintain several bank accounts, an additional description representing the name of the bank appears. For example, cash in bank security bank, or cash in bank BPI, or Bank of the Philippine Islands, or cash in bank Metro Bank. Okay, it is highly suggested that when you use the account in the journal entry, you have to include the name of the bank, given that a certain company uses different accounts. Next, we have cash in fund. If we say cash in fund, it denotes to money placed in a specific fund for a specific purpose. For example, we have petty cash fund. If we say petty cash fund, it is a fund intended to pay petty expenses, because a company cannot issue a check for small expenses. For instance, you ask your employee to buy office supplies. Now, in buying the office supplies, your employee spends cash for the jeepney fare. Now, remember, we cannot issue a check for payment to the jeepney driver, and therefore, we can get cash from the petty cash fund. Other cash in fund will be discussed in higher accounting, particularly in financial accounting. And next, we have cash equivalent. If we say cash equivalent, it refers to short-term investments made by the company. It is generally accepted that only accounts under 3 months maturity will be considered on this account. Now, aside from cash, we also have accounts receivable. And if we say accounts receivable, this refers to customers' account arising from selling activities. This account refers to a trade account receivable. Next, we have notes receivable. If we say notes receivable, This refers to account receivable or collectible of the company and is supported by a promissory note. And next, we have merchandise inventory. If we say merchandise inventory, it refers to the merchandise of the company intended for sale in the course of its business operations. And next, we have prepayments. If we say prepayments, this refers to advance payments made by the company. For example, the company paid rent in advance for 1 year, or the advance payment is called prepaid rent expense. If we pay in advance advertising expenses, then we use the prepaid advertising expense. So examples of this are prepaid rent, prepaid advertising, prepaid insurance, unused office supplies, or unused store supplies. Next, we have land. And if we say land, this is the land owned by the company that is being used in business, and it is classified as investment. And remember as well that land is the only asset that will not depreciate because it has a continuous usage, okay? So its usage will never end. Next, we have building. If we say building, this is the infrastructure owned by the company that is used in business. And we also have furniture and fixtures. Furniture and fixtures represents chairs and tables, air conditioners, cabinets, electric fans, etc. And next we have office equipment. Office equipment is the account that includes computer, calculator, typewriter, fax machine, photocopier, telephone units, and store equipment. And lastly, we have delivery equipment. Okay, there should be delivery equipment, and delivery equipment is the account that is used instead of transportation equipment sometimes. All right, so these are all our asset accounts. What about liability accounts? Now, under liability accounts, we have two. First, we have accounts payable, and we also have notes payable. If we say accounts payable, this represents the liability accounts of the company arising from purchase of merchandise that is intended for sale. On the other hand, if we say notes payable, these represent the liability accounts supported by a promissory note issued by the company. Okay, so these are our liability accounts. If we talk about capital accounts, there are also two inclusions. First, we have X capital and X withdrawal. When we say X capital, it refers to the capital account of the owner. The letter X represents the name of the owner. So supposing in academic problem where the name of the owner is given, you should replace letter X with the name of the owner as stated in the academic problem. So for example, the name of our owner is John Smith. So we should replace X with John Smith. So that becomes John Smith, comma, capital. Okay? So on the other hand, we have X withdrawal. X withdrawal refers to the withdrawal made by the company owner. So similar to capital account, whenever the name of the owner is given in an academic problem, use the name of the owner instead of letter X. So supposing in our academic problem, the name of the owner is John Smith, so we should replace X with John Smith. So that becomes John Smith, comma, capital. All right? So again, like I said earlier, there are types, different types of assets. Now in this case, there are three types of assets. First, we have current assets. Second, we have fixed assets or non-current assets. And finally, we have other assets or intangible assets. If we say current assets, these are the assets that are easily converted into cash. Now, examples under current assets, we have cash, marketable securities, accounts receivable, inventories, and prepaid expenses. Okay, so these are under current assets. On the other hand, we have fixed assets or non-current assets. If we say fixed assets or non-current assets, these are the types of assets that are not easily converted into cash. Examples are land, building, machinery, and equipment. And finally, the last type of asset, we have other assets or intangibles. So these are the types of assets that are not physical in nature. So examples are goodwill, patents, brands, copyrights, trademarks, trade secrets, licenses, and permits. Again, these are not physical in nature. And aside from assets, we also have different types of liabilities. For the first type of liability, we have short-term liabilities, or also known as current liabilities. And second, we have long-term liabilities, or also known as non-current liabilities. If we say short-term or current liabilities, these are the types of liabilities that are payable within 6 months to 1 year. So examples for these are accounts payable, accrued expenses, and short-term notes. On the other hand, if we say long-term liabilities or non-current liabilities, these are the types of liabilities that are payable more than 1 year. So examples are long-term notes and mortgage payable. Next, we have types of equity. So the types of equity, or under equity, we have preferred stock, common stock, and retained earnings. Remember that in big companies or corporations, the owners are called shareholders or stockholders, right? And these shareholders or stockholders receive dividends. If we say dividends, this is a portion of profit after tax that is given out to shareholders or stockholders. Now, preferred stockholders are the ones who receive first the dividend, and whatever is left or the residual, that will be received by the common stockholders. And if we say retained earnings, these are the earnings that are decided to be retained by the company for expansion purposes on the future. Okay, so these are the types of equity. Now, in creating or in generating a balance sheet, we need to follow the accounting equation. We have assets equals the sum of your liabilities and owner's equity. And remember, your assets should be located at the left side of your balance sheet, and your liabilities and owner's equity should be located at the right side of the balance sheet. And in categorizing your assets, it should be categorized correctly. Okay, you need to break it down per type of assets. So under assets, you should categorize the accounts, whether or not it is under current assets, fixed assets, or other assets. In liabilities side, you also need to categorize the account, whether it's under current liability or short-term liabilities, or non-current liabilities, or long-term liabilities. Plus, you have your owner's equity. And again, your total assets should be equal to the sum of your total liabilities and owner's equity. Okay, finally, those are the three keywords that we should always bear in mind if we talk about balance sheet. So again, we have assets, liabilities, and owner's equity or capital. Now, The next key area that we're going to be discussing right now, that would be the objectives of financial statements. Now, as you can notice, we have 5 objectives of financial statements. First, we have assessment of past performance. Second, we have assessment of current position. Third, we have prediction of profitability and growth prospects. Fourth, we have prediction of bankruptcy and business failures. And finally, we have assessment of operational efficiency. Now, if we see assessment of past performance, why do we need to assess past performance then? Now, we need to assess past performance because, remember, financial statements are historical and therefore a very good indicator of future operations. It is a good indicator for future operations because both potential and existing investors are normally interested in trends that can easily be facilitated in financial statement analysis. Accordingly, past performance is a good indicator of future performance. Next, we have assessment of current position. Now, if the first objective is to assess past performance as it is historical and therefore a very good indicator of future operations, now the second objective is to assess the current position. It is imperative for the business to assess its current position because if we are trying to analyze their financial statements, then the financial statement analysis will show them the current position of their business, meaning where they are and how they are performing in the market so far. And the interpretation of its prime component will certainly tell the users of the current business status. Next, we have prediction of profitability and growth prospects. Now, we make sure of the word prediction. Now, we make use of the word prediction because financial statements have predictive value once we go deeper and analyze them in relation to other account periods. And by analyzing them, we would be able to predict its profitability and growth prospects. Next, we have prediction of bankruptcy and business failures. Aside from being able to predict profitability and growth prospects, financial statements analysis can also predict bankruptcy using ratio analysis. Now, in order for us to better understand what a financial ratio analysis is and its different types, this will be further discussed in the proceeding section. And finally, we have assessment of operational efficiency. Financial analysis, remember, can also assess a company's operation through comparison of previous year's operations and an assessment of potential future operations using the planned operations. Okay, so this is our 5 objectives of financial statements. Now, we also have limitations of financial statements. As you can recall in our discussion earlier, I made mention that financial statements have feedback value and predictive value, right? Now, unless one performs a deeper analysis, he or she cannot uncover the best elements of business operations and the bad elements that can be improved. Although, we cannot deny the fact that financial analysis is a good tool in helping business decision makers, there are still 2 noted limitations that decision makers should consider. And the first one is the lack of comparability with other companies. And second, there is a need to look further beyond financial ratios. Now, if we say the lack of comparability with other companies, the differences in accounting treatments of various accounts sometimes make it very difficult to compare companies. For example, one company might be using LIFO or last in, first out, and other company is using FIFO or first in, first out. This alone could make a difference in the inventory as well as in the profits of the company, because in the period of rising prices in commodities, FIFO will result in bigger inventory, and therefore the company's ending inventory will come from the latest purchases. Higher ending inventory could result in bigger profits. And the exact opposite of this is what we call LIFO, because in a period of rising prices in commodities, it can have lower ending, resulting in smaller profits for the company. And second limitation, there is a need to look further beyond financial ratios. Now, take note that ratios are not conclusive. When I say conclusive, what I mean about this is that these ratios are not to be viewed as an end, but rather as a starting point by which the analyst could be led to a greater depth, and therefore the analyst should look at other data in order to make a sound decision, such as industry trend, technological changes, changes in customer behavior, changes in the company itself, the economy and the peace and order situation of the country, and the strong political influences of those that are in the administration and in opposition. Okay, so these are the two limitations of financial statement analysis. And the next key area that we're going to be discussing, that would be comparative income statement. Now, in order for us to better understand this, I am showing you an example of a comparative income statement. This is called comparative because we are actually comparing our income statement of the current income statement to the previous income statement. So in this case, we are comparing our income statement from year 2011, 2012, and 2013. As you can see in the net income portion, or the result of the business operation, it is apparent that the company is performing well in 2013, followed by 2011, then followed by 2012. Now with this, we might be asking ourselves, how do we achieve a comparative financial statements then? Well, comparative financial statements are achieved if there are consistent treatment of various transactions and accounts. If we say consistency, consistency happens only when the business enterprise has an accounting manual that guides the finance department staff. So basically, the contents of the accounting manual are the chart of accounts, that is a list of account titles which the company may use in all its transactions. Second, in some instances, it contains journal entries of routinary transactions. Third, it also includes accounting policies and procedures. Fourth, it also includes the organizational chart of the finance department, including its duties and responsibilities. And finally, it includes organizational chart showing the right placement of finance department in the company-wide organizational chart. Okay, the next key area that we're gonna be discussing right now, that would be vertical analysis of income statement. Now, the income statement, this is an example of a comparative income statement, but how can we determine that the analysis that we are applying is vertical analysis? Okay, so the income statement, as you can see, this is an income statement of Grand Lake Cass, okay, as shown in figure 5.2. Focuses on the major components of the income statement. Now, using the vertical analysis, sales are considered as the standard of comparison. Again, I would like to reiterate, using the vertical analysis, sales are considered as the standard of comparison at which all other figures are compared. Since sales are the standard of comparison, sales will be 100%. Now, for the year 2011, the percentage of cost of sales is computed by dividing 8,730,000 cost of sales by 17,270,000 sales. And the percentage of operating expenses is computed by dividing 6,081,325 total operating expenses by 17,270,000 sales. Now, as a learner, try using a calculator in computing percentage for years 2012 and 2013 as shown in our figure. Now, how do we interpret this one? Now, after the computational aspects, we need to analyze and observe the rise and fall of percentages from year to year. Now, in year 2011, the cost of sales is 51% and its operating expenses is 35%, right? Now, in year 2012, the cost of sales is 50% and its operating expenses is 37%. And in year 2013, the cost of sales is 47% and its operating expenses is 32%. Now, the operating performance of the company showed that it continuously improved its cost of sales from 51% in year 2011 to 47% in 2013. It is assumed that the qualities of products were not reduced because sales also increased. Neither were the company's services to their customers because operating expenses were reduced by 3% in comparison with year 2011 figures. And as stated before, these analyses are not conclusive. This will only be starting point where the company should consider non-financial aspects and discover more opportunities for growth. Okay, so this is what we call the vertical analysis of comparative income statement. So the next key area that we will be discussing, that would be the horizontal analysis of income statement. Now, this is an example of a horizontal analysis of comparative income statement. Now, in doing the horizontal analysis of an income statement, 2-year reports shall be compared and the increase of each account is computed. So these are the steps that one has to follow in order to do the horizontal analysis. First, we need to plot the report in comparative format. So in this case, this is already in comparative format because you already have your year 2013 income statement and your year 2012 income statement as well. Now, after plotting the report in comparative format, the second step that we need to do is to get the difference by subtracting the figures from the later year with the figures from the earlier year. So in the example, in figure 5.3, year 2013 figures less year 2012 figures. And finally, the last step in order to do horizontal analysis is to get the percentage of increase. Divide the difference figure in number 2 with the base year, which is the earlier year. So in our example, in figure 5.3, divide the difference with a figure in year 2012. Now, how do we interpret the result? So as you can see, this is our result. Our sales is 23%. Our cost of sales, we have 14%. Our gross profit, we have 31%. Our operating expenses, we have 6%. And our net income before tax, income tax, and net income after tax are 101% respectively. Now, in interpreting the result, the reason for the good performance is that sales increased by 23% in comparison with the cost of sales 14% and the operating expenses 6% only. As a result, the operating performance has increased by 101%. Okay, so this is how we do horizontal analysis of comparative income statement. And the next key area that we're gonna be discussing, that would be the vertical analysis of statement of financial condition, or what we call the balance sheet. Okay, in order for us to better understand this, let me show you an example. So this is an example of vertical analysis of statement of financial condition, or what we call balance sheet. So just like with the income statement presented previously, the accounts presentation in figure 5.5 were restructured for easy computation for ratios. This is figure 5.5, and so it will be easy for us to calculate financial ratios. So how is the percentage of change computed? Now, as you can see on figure 5.5, in this case, we take the total asset as the standard of comparison. Again, we take the total asset as the standard of comparison. So in computing the percentages, we need to divide the figures with the total assets. For example, in year 2013, current assets of 1,105,500 divided by the total assets of 6,688,620, and the result is 17%. And for non-current assets, 5,583,120 divided by total assets 6,688,620, and the result is 83%. Now for current liabilities, 1,664,415 divided by total assets of 6,688,620, and the result is 25%. And for non-current liabilities, 1,500,000 divided by your total assets 6,688,620, and the result is 22%. And finally, the stockholders' equity of 3,524,205 divided by total assets 6,688,620, and the result is 53%. Now, to interpret the results, the company has put 17% of its total assets to current assets. Current assets are very important to a business, as this will be your working capital. Again, current assets are very important to a business, as this will be your working capital. And if the business has difficulty in working capital, it will resort to short-term borrowing to sustain the day-to-day operations. And take note, the current liabilities are 25% of the total assets. This means that the company is taking the creditors to participate in the sustainability of its working capital. And for the meantime, it can be assumed that there is a delay in the payment to creditors just to sustain the operations. All right, so that was all about vertical analysis of statement of financial condition. So moving on to our next key area, we have horizontal analysis of statement of financial condition or balance sheet. Now, this is an example of a horizontal analysis of statement of financial condition. Now, the procedure for the computation of percentages of change is the same as discussed previously. Now, the findings in the vertical analysis of the company that it is using its creditors in the sustainability of its working capital, it is also manifested in the horizontal analysis. It shows that there is a 75% increase in the current liabilities.